Picture me at 20, broke, in college, and stopping at a folding table outside of JCPenney where they're handing out credit cards like candy bars. I signed up, got approved for a $300 limit with no job, and thought I just landed free money. My very first swipe was $280 on clothes, and let me tell you, that swipe turned into years of regret. But I'll circle back to that and how deep that hole went and what it looked like to climb out later in the video, because it ties directly to why paying off debt right now is so urgent. Here's the thing. Debt isn't just a monthly bill. When the economy starts wobbling, debt becomes an anchor that can drag you down faster than you think. And if you're worried about where things are heading, getting rid of it now is one of the smartest moves that you can possibly make. Hi, my friend. If you're new here, my name is Sarah. I'm the owner of FrozenPennies.com. I'm a financial coach and the author of the international best-selling book, Fundamentally Frugal, link below. Today, we're diving into 7 urgent reasons to pay off your debt before the economy crashes. I'm not saying this to try to scare you, and nobody really knows what the future holds. Depending on which expert you listen to will depend on what you believe. Now, I still believe now is still the best time to tackle this. By the end of this video, you'll know exactly how getting rid of debt builds resilience, flexibility, and peace of mind no matter what the future brings. Debt costs you more when times get tight. Debt is like that one friend who always borrows snacks but never buys their own. It just keeps taking. Credit cards today then can carry an interest rates from 24 to 29% or higher, which means for every $100 you spend, you could be paying $24 to $30 for the privilege of using somebody else's money. And here's the kicker. That interest piles on top of interest, turning your $280 sweater into a $500 sweater you don't even like 6 months later. Back in my JCPenney card days, I remember opening my statement, paying the minimum balance, and feeling like I'd made progress. Then I'd look at the next month's statement and the balance was the same, or worse. It felt like trying to scoop water out of a sinking boat with a teaspoon. The reality is minimum payments aren't designed to help you. They're designed to keep you paying forever. If the economy continues to slide and your income dips, interest doesn't slow down out of pity. It speeds up. Imagine owing $3,000 on a credit card with a 24% interest rate. If you only make the minimum payment, it takes you more than 10 years to pay it off. And you'll spend almost as much in interest as your original balance. That's like paying twice for the same pizza and still not getting extra cheese. When times are tough, every dollar counts. By paying off high interest debt now, you free up money that you can put toward groceries, toward gas, or toward savings. That's not just smart, it's survival planning. A strong credit score becomes your lifeline. Think of your credit score as your financial reputation. Some experts say that you can get a mortgage without a credit score. You just have to find a bank that still does manual underwriting. And those are becoming fewer and fewer. When the economy is stable, maybe you don't worry about it too much. But when times get shaky, banks get picky. They raise lending standards, which means only the people with the best credit scores get the lowest interest rates and access to loans. Everyone else gets hit with sky-high rates or flat out rejected. Here's the thing. Your credit score isn't just about bragging rights. It affects your insurance premiums, whether you can refinance your mortgage, or even your ability to rent an apartment. And it's heavily tied to your debt. Carrying big balances raises your utilization ratio, which lowers your score. Late payments crush it even more. Paying down debt is now one of the fastest ways to improve your credit score. And uncertain times, that score can be the difference between being able to pivot when you need to or being stuck. Imagine needing to move during a recession, but being denied an apartment because of your credit score. That's stress you don't need. By tackling debt today, you're building a financial safety net for tomorrow. Debt-free means flexibility. Life loves to throw curveballs, usually when you least expect them. Job losses, medical bills, car repairs, none of these emergencies wait for the economy to calm down. And if you're carrying debt, those surprises hit even harder. Think about it. If you lose your job and already have $600 a month going toward debt payments, you're instantly behind. But if you're debt-free, you can stretch your unemployment check, side hustle money, or savings so much further. Debt-free living isn't just about peace of mind, it's about flexibility. You can make choices based on what's best for you, not what Visa or MasterCard demand. When I finally paid off my last credit card, the feeling was incredible. It wasn't just that I had more money in my account each month, it was that I suddenly had options. If I wanted to work less, I could. If I wanted to take a risk and start my business, I could. Flexibility is freedom, and in a fragile economy, freedom is priceless. Home equity can be a tool, but not a crutch. If you own a home, you may have some equity built up, and yes, people use home equity lines of credit, HELOCs, to wipe out high interest debt. On paper, it makes perfect sense. Pay off a 24% credit card with an 8% HELOC. That's like replacing a raging house fire with a candle. But here's a catch. A HELOC is tied to your house. If you can't pay, the bank doesn't just take away your credit card, they can take away your home. In an unstable economy, that's not a gamble you want to make. No, I'm not saying HELOCs are evil. If you have a solid repayment plan and the discipline to not run your credit cards back up, they can be a useful tool. But they're not a solution for bad habits. They're a parachute, not a safety net. Use them wisely, or you risk trading one problem for a much bigger one. You need an emergency fund more than ever. Here's a trap I see all of the time. People get so focused on paying off debt that they ignore savings. They throw every dollar at the balance, which feels good until the car breaks down. Then what happens? Out comes the credit card, and the cycle starts all over again. That's why an emergency fund is your lifeboat. Experts recommend 3 to 6 months of expenses tucked away, but even $1,000 can make a huge difference. It's not just money, it's breathing room, it's peace of mind. And I go into this in detail in my book, Fundamentally Frugal. Think of it this way. Paying off debt gets you out of the hole, but saving keeps you from falling back in. During my own debt payoff journey, there were moments I had no cash cushion. And sure enough, the second something unexpected happens, we were screwed. It felt like trying to run a race with my shoelaces tied together. Do not skip this step. I remember when our hot water heater went. We'd only lived here 3 months. Our credit card situation was so bad that even though we didn't have an emergency fund, we also didn't have credit cards to fall back on. So we went 2 weeks without hot water until we had enough to replace the heater. Momentum creates motivation. Debt feels overwhelming because it feels endless. Like no matter how much you pay, the balance just laughs at you. But here's the magic. Once you pick a strategy, momentum kicks in. The snowball method. Paying off the smallest balance first gives you quick wins. It's like knocking down the smallest domino and watching the rest fall. It's my favorite way to get out of debt. The avalanche method. Paying off the highest interest debt first saves you the most money. Either way, you start to see progress, and that progress is addicting. I remember the first card I paid off completely. It wasn't even my biggest balance, but the rush of saying $0 due was incredible. It made me want to keep going. In uncertain times, motivation is fuel, and happy dances happen. Debt payoff builds momentum, and momentum keeps you moving forward even when everything else feels a little stuck. Debt freedom makes you recession resilient. Not the end of the day, debt is a weakness. In a booming economy, it's easy to ignore, but when things get tough, debt makes you feel vulnerable. If the economy crashes, debt doesn't disappear. The bills still come, the interest still compounds, and if your income takes a hit, those payments can crush you. Paying off debt now makes you stronger. It gives you stability when the ground shakes. It makes you adaptable when things change, and it gives you control at a time when so much feels completely out of control. Imagine facing a recession with no debt, money in your savings, and options in your back pocket. That's not just security, that's confidence. And confidence is priceless when the headlines are screaming doom and gloom. Stress reduction and mental health. Debt isn't just numbers on paper. It's that pit in your stomach when the phone rings, that heaviness when you open the mailbox. Studies show that financial stress is one of the leading causes of anxiety, depression, and even physical health problems. When the economy gets shaky, that stress only multiplies. Paying off debt lifts that weight. Imagine checking the mail and not bracing for a bill, or answering the phone without fear it's a collector. Peace of mind is priceless, especially when the world feels heavy enough already. Building wealth instead of feeding banks. Every dollar you spend on interest is a dollar you don't invest in your own future. When you're debt-free, you can redirect that money into savings, retirement accounts, or even just experiences that bring you joy, like a beach vacation without guilt. In times of uncertainty, building wealth even slowly is one of the best shields against hardships. Paying off debt now means you can start compounding your money for it, not for the credit card company. Think of it like flipping the script. Stop being their investment and start being your own. Setting the example for your family. Kids may not understand interest rates, but they sure understand stress. They watch how we handle money, even when we don't realize it. When you show them what it looks like to face debt head on and win, you're teaching them resilience and responsibility. And when the economy feels uncertain, giving your family stability financially and emotionally is one of the best gifts you can offer. Paying off debt isn't just about you. It's about the example you set for everyone watching. Remember me, that broke 20-year-old filling out that credit card application outside of JCPenney? That $280 shopping spree spiraled into 5 years of debt and another 10 years of clawing my way out. If I could go back and talk to her, I'd tell her this: debt isn't just a burden, it's a barrier. It steals your freedom, your choices, and your peace of mind. The best gift that you can give your future self, especially when the economy feels fragile, is to tackle it head on. Don't wait for the crash, get ahead of it. And if this video spoke to you, don't forget to like, share, subscribe, and watch this video next.